SA 700, Forming an Opinion and Reporting on Financial Statements. Audit Report Hint, Tab GK, MRO, SPD, UDIN, T, Title, clearly indicate Report of Independent Auditor. Generally used wording will be Independent Auditor's Report. Second, addressee. Addressed as per circumstances, it may be prescribed in law or regulation or terms of engagement. If not, it can be addressed to those charged with the governance or shareholders. As per section 143 subsection 2, the audit report need to be addressed to shareholders. Third, auditor's opinion. Heading, opinion. Initial content is intro. We have audited financial statements. Identify which entity. Identify title of each statement in set of financial statements. Refer to notes, including summary of significant accounting policies, dates or period covered by financial statements. Ultimate content, opinion, wordings in case of fair financial reporting framework, whether financial statements are as per applicable financial reporting framework, whether financial statements give true and fair view or presents fairly in all material respects. In case of compliance framework, whether financial statements are as per applicable financial reporting framework, that is compliance framework. Fourth one, basis of opinion. Basis of opinion. Why opinion is reliable. Declaration by auditor that he is independent as per code of ethics and also fulfilling other ethical requirements such as integrity, objectivity, professional competence and due care, professional behavior, and confidentiality. Audit is conducted as per essays issued under Section 143, subsection 10. For further details on how work was conducted, refer Auditor Responsibility section. To assure everyone's statement that auditor obtained sufficient and appropriate evidence to provide auditor's opinion. Next, going concern, if required. Where applicable, the auditor shall report in accordance with SA 570 revised. This is generally required if there exists material uncertainty unless it is covered in basis of opinion paragraph. Key audit matter, if applicable, as per requirements of SA 701. Next, responsibility of management for the financial statements. Heading, depending on circumstances like law applicable, nature of entity, etc. Heading can refer to management or also those charged with the governance as the case may be. Description of responsibility for financial statements. In case of compliance framework, whether preparation of financial statements are as per compliance framework. In case of fair presentation framework, whether preparation of financial statements are as per fair presentation framework, ensure financial statements give true and fair view. Two more to support above. Also, responsibility to create and maintain internal control system to support above. Internal control system should be created and managed by the management only. So it is the responsibility of management. Third responsibility of management is a responsibility to assess whether going concern assessment is appropriate, disclosure of issues regarding going concern, and statement on appropriateness of going concern. Next, identify people who are responsible for oversight of financial reporting process. If those charged with the governance is responsible, include their name in heading. As per company law, IFCR is responsibility of board of directors. Next, auditor's responsibility. Three paras govern this section. Para 37, objectives. Reasonable assurance plus free from material misstatements and issue audit report. Meaning of reasonable assurance, meaning of materiality, comment about misstatement. Include always in auditor's report and no other option. Next, para number 38, scope. Auditor related points. Professional judgment and professional skepticism. Skepticism means alertness. He should be, the auditor should always be professional skepticism, should maintain professional skepticism and should always be alert. Process related points. Identify risk of material misstatements. Risk of material misstatements due to fraud may involve omission, misrepresentation, forgery, collusion, and override of internal control system. design and perform audit procedures, obtain audit evidence. Important points: evaluate accounting policy or reasonableness of estimates and disclosures. If fair presentation framework, evaluate overall presentation structure, content, and disclosures, appropriateness of going concern. Internal control system related points, non-corporates. We understand internal control system, but not for expressing opinion regarding corporates because of a legal requirement to report on internal financial control over financial reporting. Above our statement regarding not expressing opinion cannot be written in company auditor's report. Next, regarding branch related points, division of responsibility by auditor, either division or branch or subsidiary covered by another auditor. Next, para 39, communication, statement on communication regarding ethical requirements and independence, planned scope and timing of audit, significant audit findings including significant deficiencies. If key audit matter applicable, explain matters in key audit matter are most significant. They are selected from communication to those charged with the governance. Other reporting responsibilities. For reporting responsibilities other than those specified in earlier sections as per any law or regulations, if topics are same, include it in above sections only, but specify as per which provision so as to differentiate it. If we include this as a section of a audit report, then we need to give heading to above part as report on financial statements. Regarding auditor's responsibility, there are three options: including report, include it in appendix or annexure of report, give reference and description given on website of authority, plus it is as per SA 700, plus give reference is ever given reference is allowed as per law and given line and give line. Last, signature by individual or partner, name, specifying name of the member and name of the firm, registration number, membership registration number MRN, firm registration number FRN. Date of signing should be specified. Place where report is signed should be specified. Generally, it is the city where office is situated. Last, UDIN, unique document identification number. It should be specified on the audit report. UDIN should be generated within 60 days of signing document. Next, forming opinion on financial statements. What opinion auditor has to frame? User expects financial statements are as per standard principles and format. That means they should be as per AS, Ind AS, IFRS, etc. So auditor has to make opinion whether financial statements is as per applicable financial reporting framework. If it is a fair presentation framework, auditor also need to express whether financial statements give true and fair view. How to frame opinion? To frame opinion on financial statements, auditor will have to make a conclusion about all material items in financial statements are free from material misstatements, may be because of fraud or error. While making these conclusions, auditors should be reasonably assured, that is, high level of confidence. How to draw conclusions? For drawing conclusions, following should be done: perform audit procedures and obtain sufficient and appropriate audit evidence for all material items. On the basis of evidence, identify misstatements in financial statements and ask management to rectify them, and then make list of uncorrected misstatements. Now auditor have to check these misstatements individually or in aggregate. Apart from quantitative misstatements, it is important for auditor to understand the quality of financial statements or accounting practices or management bias to form an opinion on financial statements. Specific evaluation by auditor. SS 700 makes some evaluation mandatory for auditor because they are extremely important and they don't want auditor to miss it in any manner. Hint is master. Auditor has to evaluate following. First one, material transactions and events are properly accounted and disclosed in the financial statements so that user understand their nature and financial effects. A. Applicable financial reporting framework. Whether applicable financial reporting framework is followed consistently while selecting and implementing accounting policies. S. Whether significant accounting policies are properly disclosed in notes to accounts. T. Terminology. Whether terminology used in financial statements, including the title of financial statements, is appropriate. Example title for profit oriented and non profit oriented company is different. E. Estimates. Whether estimates made by the management appear reasonable, that is realistic. R. Whether financial statements as a whole are relevant, reliable, comparable, and understandable. Understandable. Audit report prescribed by law. If law prescribes format of audit report, then as law overrides standards, hence auditor will have to follow format given by the law. Here law prevails over standards on auditing. He will give reference to standards on auditing in his audit report only if audit reports includes basic elements which we have discussed earlier other than conditional elements, which means all elements from title to date. In India, we don't refer to standards in tax audit report because it doesn't contain management responsibility and auditor's responsibility paragraph. References to multiple standards on auditing and multiple FRFs, financial reporting frameworks in audit report. In case of multiple standards on auditing, there can be a situation where there are investors from different regions. For example, US, Japan, India, they will demand audit as per international standards on auditing, Japanese standards, and Indian standards. It is possible that we refer to multiple standards on auditing in audit report and say that audit was conducted according to them if following conditions are satisfied. There should not be conflict between standards with respect to time or form of opinion, inclusion or exclusion of EMP or OMP. It should contain minimum elements of audit report from title to date. Explain origin. When the auditor's report refers to both the international standards on auditing or the auditing standards of a specific jurisdiction and the standards on auditing issued by ICAI, the auditor's report shall clearly identify the same, including the jurisdiction of the origin of the other auditing standards. Next, in case of multiple financial reporting frameworks situation, there can be different users demanding financial statements as per financial reporting framework like IFRS and Ind AS. We can mention both financial reporting framework in one audit report provided below conditions are satisfied. There should be full compliance of both the financial reporting frameworks. That means all income, expenses, assets, liabilities, notes to accounts should comply with the standards. Final result like profits, net assets should be same as per both the financial reporting framework and no reconciliation need to be prepared. Sometimes entity prepare financial statements as per one financial reporting framework and then they give reconciliation of profit from framework they follow to other framework in notes to accounts. In this situation, we will not refer to two financial reporting frameworks in audit report because one financial reporting framework is followed in financial statements. Only one financial reporting framework should be followed in financial statements. If in case of multiple FRFs, if difference exists, two audit reports can be given. Next, supplementary information. It is the additional information not required by financial reporting framework. It is given either voluntary or as per law or regulations. Example as per MSMED Act or profit reconciliation or list of debtors or employees. If it is integral part of financial statements, examine it, cover it as normal information in notes. If it is not the integral part of financial statements, ask management to clearly differentiate it and put it under the heading unaudited, plus no cross referencing. If it is done, okay. If it is not done, mention in report. We don't take responsibility. It will be treated as other information as per SS 720. Examples. Example of integral part. In notes to accounts, company can explain to what extent financial statements are as per another financial reporting framework and they can reconcile profit as per applicable financial reporting framework with profit as per another financial reporting framework by indicating which financial items should be reversed. In this situation, it is not possible to segregate these things from financial statements as they have very close connection with the items presented in financial statements. Hence, the auditor need to cover it as regular notes to accounts and cover it in his audit. Example number 2 regarding non-integral part. If entity gives additional P&L in appendix to financial statements, and this additional P&L has items of income and expenses which are altogether different as what are presented in current P&L, then this is the information which can be clearly segregated and differentiated. In such situation, company should differentiate it from financial statements and put it under the heading supplementary information plus unaudited, and the auditor is not supposed to cover it. Next, evaluation of qualitative aspects including management bias. Qualitative aspects of accounting practices are financial statements. Essay 260 explains what are the qualitative aspects of accounting practices, and they majorly focus on three things: AED, accounting policies, significant accounting policies; estimates, management estimates and judgments; D, disclosures, disclosures in financial statements; management bias. Management has to make many judgments while doing accounting and preparing financial statements. There is a possibility that they misuse this opportunity and enforce their hidden agenda of manipulating financial statements. So, auditor should be careful and understand whether management appear biased. To understand whether management is biased or lack neutrality, auditor should see following: whether there are selective correction by management with respect to managed misstatements identified by auditor, which may either only increasing earnings or decreasing earnings. Management is not rectifying deficiencies in the system which are focusing on particular transaction balances or disclosures leading to inappropriate reporting. Whether there is possible management bias while determining accounting estimates. Now, how to understand whether management is biased in estimates is explained in Essay 540, which gives examples and circumstance of management is biased in making accounting estimates. Effect of low quality accounting practices and management bias. If we identify that quality of odd accounting practices is low or management is biased, this is itself is not a material misstatement which should be reported. But while evaluating misstatements, then we should consider effect to low quality accounting practice and management bias while drawing opinion, and because of this we may draw opinion which is unfavorable, so they affect opinion making process. What is the difference between audit report and audit certificate? Audit report generally covers whole financial statements, whereas audit certificate generally covers limited information. While issuing audit report and audit certificate, similar methods of procedure and evidence are there. Similar methods are used. While issuing audit report, we use the judgment. Auditor will use the judgment, whereas while issuing audit certificate, judgment will not be used. While issuing audit report, final result opinion will be opinion with a reasonable assurance. While issuing audit certificate, the final result will be regarding accuracy of vouching. In case of audit report, opinion is based on facts. In case of audit certificate, here we comment on accuracy of the facts itself. Example of audit report. The report under section 143 of Companies Act 2013 is an opinion-based report and not a certificate. Next, example of audit certificate. As per section 66 of Companies Act 2013, an auditor is required to file a certificate in the tribunal where company is proposing for reduction of capital. Next, reporting to shareholders versus reporting to those charged with the governance. Requirement. Section 143 of Companies Act 2013 deals with the provisions relating to reporting to shareholders. Thus, it is a statutory audit report which is addressed to the members. As per Essay 260, Essay 260 deals with provisions relating to reporting to those charged with the governance. Next, statutory audit report is on true and fair view and as per prescribed format. Whereas reporting to those charged with the governance is a reporting on matters those charged with the governance like scope of audit, audit procedures, audit modifications, etc. Statutory audit reports are in public domain, whereas reporting to those charged with the governance is an internal document, that is, it is a private report. It is not available in public domain.